Hello, it's Richard C. Wilson of the Family Office Club. I have with me here today. Welcome, John.
Hey, thanks.
Thanks for being here.
Glad to be here.
Great. So, what really do?
Yeah, so we just turned 18 years old, so I guess we can vote. We were founded out of the ashes of Arthur Andersen, so a lot of great things I think came from Arthur Andersen. Great firm. We are a multifamily office, over 60% owned by a group of clients. Not all of our clients, just some original ones and some to that. And we have 58 client families in 30 different states. Notwithstanding our name, most of our clients and assets are outside of the wonderful metropolis of St. Louis, Missouri. And so we're a multifamily office. We help our clients with everything. We have 53 employees serving 58 client families, about 200 million of wealth per family on average. Kind of ranges, kind of our sweet spot is the 50 to 500 million range. We have some over that and some under that, but that's kind of who we work with.
Okay. And what's the scope? I mean, with that many clients, I'm sure there's a very wide breadth of investment scope, but can you talk a little bit about what they're putting their capital into as an average family at 200 million net worth, and where there's kind of a gap of with 58 people, I'm sure you're able to go out, do research, and fill any gap fluidly as it comes up. But where is there kind of a thirst for more types of direct investments or deal flow?
Yeah, sure. I would say that, first of all, to start with, we don't really, well, we definitely have our own recommended investments and, mainly oversee what our report on and allocate and recommend what our clients invest in. We also have a lot of other investment advisors that we work with. So, most families that come to us don't just say, hey, I want to fire my existing investment advisor or I have this big bag of cash, even though it does sometimes happen. I mean, they often have, like, I want to keep my relationship with my Goldman Sachs broker or this IRA or this, I have money that I don't want to move. And we're totally fine with that. We're agnostic about where it is. We download every night from over 70 custodians. I would say what's interesting is over the years, we have both recommended and clients have also followed on with in the public markets, we've gone more and more passive. Some of that's just cap weighted index passive, a lot of tax managed indexing. We use a lot of parametric and a Aperio group. So we also have done more and more factor based passive. I think that's a great way to, really replicate a lot of what the managers are doing with, better success, lower fees, lower taxes. Really where the differentiation comes in and the ability to outperform, because if you think about it, to outperform, you need to have at least one of three things. You need to have better information, better analysis, or better behavior. If you think about the public markets, it's almost impossible to have the first two.
Right.
So we hire managers in the public sphere that have better behavior, which often means having lockups so they can not be chasing returns. But if you think about private markets, you can have all three of those things.
Sure.
Yeah. So that's where we look more to access the higher performing managers.
Okay.
Or in public markets that are more, concentrated and often have lockups.
Okay. I'm curious. A lot of multifamily offices have challenges when they're not serving a $200 million family on average, just dealing with a family saying, hey, I want to buy some pharmaceutical companies, or hey, I want to do direct investments in manufacturing or direct real estate properties. How do you integrate, support, help with due diligence, or protect them from themselves, or help them get deal flow? How does that work with your quality of clientele?
Yeah. So to your point, even a family that has, $100 million often will struggle to meaningfully access the private markets because it's usually not a single $100 million portfolio. It's mom and dad have 40 million and there's another 30 million in a family trust and it's in all these trusts. And so you struggle with minimums and diversifying by, vintage year and style and everything else. So that still is a challenge. And then you have fund of funds, but then you worry about, the extra layer of fees and, do they truly have access? So that's definitely a challenge. So it does take quite a few assets to meaningfully and professionally access the private markets. It's interesting. Direct investing has become, such a hot area, and it's a little bit of a head scratcher. Because if you think about it, especially in the startup space, it's so hard to do well. I mean, venture capital as an asset class has really usually struggled, right?
Right.
And it's really the
right.
top managers, the founders funds and the Greylocks and the Andreessen Horowitzes and et cetera, that have done well. And there's a persistence there because there's a certain amount of deal flow and then cachet and everything else you get from being one of these top VCs. So a thing we start with our clients is, did you find this deal or this deal find you? And why do we think that you can do better than a venture capital fund? I mean, we're much more in favor of, let's go to a private equity fund, whether it's, buyout or growth capital or VC or whatever, unless this is your business. I mean, we definitely have some clients that, they made their money in a particular industry and they have connections and it's great. Or there's club investing, you get together with other families but outside of that, I just think it's really challenging. And there's this siren song of ideas where you think an idea is a good idea, so you want to invest. But really, and Richard, I'm sure you know this, it's really about who's your partner and picking the right horse. Okay. It's not about, which industry or idea. It's more about finding the right person, because most of us are not able to understand what a great idea is, because great ideas often sound crazy, right?
Right.
You look back and you're like, oh, we're going to create a private company that going to compete with governments to put satellites into orbit. I mean, we're going to build your own teddy bear. We're, on and on and on. Airbnb sounded crazy. So we tell our clients it's not. So we have this whole checklist of we call it 10 ways not to lose your money. And it's 10 red flags to look for in private deals. And the very last, number 10, is, what's the idea? You got to get through the other 9 first. And it's really hard. So in a non-emotional way, we work with our clients and say, okay, let's check these boxes. And, we have a number of clients that are just really sophisticated private investors that we're helping as a sounding board. And then we have others that, bring us stuff. We're probably looking at a private deal once a week. But we've kind of stayed away from, investing a lot of our time and effort in finding deal flow.
Right.
Because again, we kind of look to our, the clients that should be doing that are doing that.
Right. Yeah, there's a lot of things right there. I mean, what we've been doing is focusing on we're like in a investor club for non-startups at the privateequity.com level. So Family Office Club is 2,000 investors, and all types of deals come through the club. We've got lots of angel investors and people that love early stage tech. But because there's 500 angel investment groups on every corner, and there's some very well-ran ones that are very deep on due diligence, we let them do their thing. Yeah. And for the 207 investors that we look for directs for, we just kind of stay away from early stage stuff completely because of what you just said. Yeah. We look for kind of boring, relatively low risk, moderate return deals. Maybe there's some good upside that could happen in it, but get their money off the table. But to your point, the families who have the deepest expertise and can really pick the greatest investments have usually made their money in that space. And you're not going to be smarter than them at that space. And you're also not going to be able to take some deal easily and show it to all 200 families and say, yeah, this deal is good for all of you, because they can't add strategic value to the deal unless they made their money in that space. So it's a tough thing to navigate, I know. I'm also curious, and then I'll get to the last question, because I know we're trying to wrap this up, somewhat quickly. What's the number one thing that's really allowed you guys to grow to $10 billion in assets, and 50 employees? A lot of multifamily offices are at 1 billion, 2 billion, and they're very proud of that. Yeah. What's the difference that you guys are 10 times the size of a respectable multifamily office?
So we get a good referrals from clients and other advisors that work with us. I mean, I think our goal is to be in our little niche, pretty differentiated. So it's it's the idea that we have about a 1-to-1 employee to client ratio. Our client service people only work with, 5 or 6 client families a piece. And I think that, it was really hard when we were young as a company to stick to that discipline. And we've continued to find clients that fit well. So we do a great job on this certain slice of client. And even if a client's going to be profitable, we don't take them unless they fit our criteria. And then they become incredibly happy and raging fans and refer us. But it's because we were like, okay, we're just going to do this. Yeah. This right here.
Right. Yeah. Makes sense. There's only a couple firms that are as successful as you guys across hundreds and hundreds that we meet per year. And by chance, one of the other ones I'm thinking of says the exact same thing. That said, if we tried to serve a lower end client, it would sink the boat. Yeah. And it has to be this certain type of client that needs a certain type of thing. And it's interesting that you both say that. So I appreciate you sharing that. I think that'll help those of many type listening to this, whether they're a hedge fund, a private equity fund, a real estate development firm, sticking to that knitting where you're really excellent and your clients know that you are in that one thing.
Yeah, I was asked recently, looking back over 18 years, what are the 2 big things that I regret or would have done differently? Yeah. And I've been there since the founding. I was one of the founding principals. And it's 2 things. When we have employees that we don't think is going to work out, to fire them sooner.
It never gets better, does it?
It does not get better, or not enough of the time to do it. It just makes things worse. And taking clients that weren't fits. Mm-hmm. We took a client 5 years ago. We knew he wasn't a good fit, but we were, competing with Goldman Sachs on it and just got our competitive juices flowing and wanted to win. And then we won. And then 2 years later, we're like, okay, this isn't a fit.
Right.
And that's happened enough that I just continue to kick myself. But you want to serve people and it's really the discipline to only take clients that are fits. And even COVID and, if assets are down and everything, you're like, oh, we need to shore up and make money. And we've still tried to have that discipline of, okay, even though financial times are tough, we need to be disciplined about who we take in. It'd be better to have a down year than to take clients that aren't fits.
Right. Yeah, we had experience last year with a $130 million family we onboarded, just not a good fit. But then we almost got our number 2 on a $240 million net worth family. We didn't get it, but he's keeping in touch proactively with us, which we see is a good sign. We're keeping in touch proactively. He's such a good fit. He's going to be our client one day. Maybe it's going to take us 12 years. But he's just the right type of character in person. So I can relate to that, 100%. Great. Well, I think we've taken up enough of your time here today. If anyone listening would like to get a hold of John, it's one of the benefits of membership. Connect you if there's some way to work together.
Yeah, and I write a blog most days, so love to have subscribers to that. You can find that in my LinkedIn or company. I also write for Forbes and do a few columns a month for Forbes. Great. So always love to have readers.
Yeah, awesome. Maybe that's something that we can share some of that content and get that exposed to some of our members and help you grow that as a thank you for being on.
Yeah, my most recent article is on why the stock market doesn't make any sense.
Yeah. Everyone will agree with that premise.
Yeah, but it's why that's the case. Okay.
Yeah. Great. Well, appreciate your time here today, John. Take care.
Cool. Thanks, Richard.